Now we want to talk about investing in companies that pay fully franked dividends. So what is a fully franked dividend?
Corey, all a fully franked dividend is a dividend that's been paid to the investor where taxes are already being paid by the company before giving it to the investor.
What does that mean for investors?
Really what it means is that the company's paid tax at the company tax rate before giving it to the investor, and dividend imputation is just a mechanism to avoid double taxation. So rather than being paid at the company level and then the individual paying again at the individual's tax.
So how does it work?
Best off with an example. So if you think about somebody whose sole source of income was, say, $10,000 of fully franked dividends, they'd get their dividends, they wouldn't pay tax on that because they're below the tax-free threshold, but they'd actually get the tax back that the company's paid already, which would equate to a little more than $4,200. So they get their dividends, plus they'd actually get a tax refund.
So it sounds complex. Is there a rule of thumb you can apply to help everyone understand this?
Yeah, for fully franked dividends, the best rule of thumb is that if you can get a 5% fully franked dividend, that equates to about 7.1% that you would have to get on term deposit to equal after tax the 5% fully franked dividend. So that's the best rule of thumb.
Clearly all scenarios are different though, so how can I find out more about my personal scenario?
Yeah, well everyone's tax rate's different of course, and so to find out more either email us or give us a call.